So today we're diving into one of the most frustrating, almost cruel paradoxes
Mhm.
that you find in high-stakes speculation. And if you've ever tried trading or investing, you have almost certainly felt this yourself. Why is it that so many retail traders, people who are technically right more often than they are wrong,
Yeah.
sometimes with a 60% win rate, still end up losing money overall? It just feels completely counterintuitive, almost like the game is rigged.
It is the brutal mathematical reality of the market. And, the sources we looked at, they confirm the shocking math behind it. A major, really exhaustive study on retail trading habits showed exactly what you just described.
Sure.
Traders often win 6 trades out of every 10. But here's the fatal flaw. The average size of their loss is consistently double the size of their average win.
Wow. So, okay, let's break that down. If you win $50 on 6 trades,
Right.
that's $300 in your pocket. But then you lose $100 on the 4 that go bad.
Which is $400 lost.
So you've won more often, but your account is actually down $100.
Precisely. The fundamental problem for, I'd say, the vast majority of speculators isn't their ability to pick a stock or a direction. It's their emotional inability to maximize the gains on those winners and their refusal to just ruthlessly manage the size of their losses. So they're successful in their forecasts, but they're completely unsuccessful in their financial execution.
Okay, let's really unpack this, because today we are doing a deep dive into the exact systematic strategy designed to permanently fix that fatal flaw. We're exploring the concept of pyramiding, which is really the highly disciplined art of adding to winning trades. We're going to get into the modern logic behind it, and then we'll break down the legendary, almost scientific, step-by-step blueprint used by Jesse Livermore, arguably the greatest speculator in history.
And our mission for this deep dive is to find that actionable framework, the actual rules that automatically forces your largest capital commitments, your biggest, most confident bets, to be inherently aligned with your most successful market-validated ideas. It's a method designed to make absolutely sure that when you're right, you are right big.
Okay, but before we get to the mechanics, we have to talk about the psychology for a minute, because this is where most people fail, right? Why do we, as humans, consistently jump out of winning trades early? Snatching a tiny profit before the market takes it away. Yet we will clutch on to losing trades for dear life, just hoping and praying they come back to break even.
It's rooted entirely in fear and hope. Simple as that. Two of the most destructive emotions in trading. The sources all highlight that the amateur's primary fear is accepting a loss, crystallizing it. If the trade is down 20%, they hold on because it's still just a paper loss.
Right, there's still hope.
Exactly. They cling to hope. But when a trade is up 10%, they sell it instantly because they're afraid the profit will vanish. And adding to that winner, it just feels completely wrong because our gut instinct is to buy low and sell high. Buying higher feels reckless.
In Livermore, he really put his finger on this. He called it the folly of the all-in bet.
He did. The amateur, driven by impatience or just pure conviction, commits their entire intended position the second they enter the trade. They maximize their risk at the precise moment of maximum uncertainty, before the market has given them a single shred of evidence that their analysis is even correct.
That is a really powerful insight. You're basically launching your entire military campaign without doing any reconnaissance first, or, I don't know, committing to a huge life change like a new career before even testing the waters. It's illogical.
And the professional mindset dictates something completely different. It says you must survive to play another day, and survival depends entirely on making multiples more on your winners than you lose on your failures. Pyramiding is the mechanical, disciplined solution that forces that ratio to be in your favor. It makes you prove your idea is right before you're allowed to bet aggressively on it.
All right, let's start with a simpler, more modern concept that underpins this whole philosophy: scaling in. It's often talked about today as the quarters theory. How does this basic structure start to fix those behavioral flaws?
Well, it forces discipline by treating your risk budget like a limited divisible resource. So instead of one big entry, you divide your total acceptable risk into smaller, manageable chunks, say 4 parts. If your absolute maximum risk for an idea is $20, you make 4 separate $5 entries over time. The rule is you simply cannot commit the full $20 up front.
And the most critical piece here, and this is where that amateur mindset really breaks down, is the initial tester position.
Yeah.
You have to start small. You're
Right.
just risking that initial $5, right? Just to get a feel for things.
Yes. That first entry is just a small probe. Its only purpose is to gauge the market's immediate bias. And if that initial tester position loses money, the loss is inconsequential. It's just a scratch. Because the paramount principle here is that the market must earn your next entry. You only add your next position after the first one is already showing a profit.
The math on this is just incredible when you see it. A system this robust means a trader could actually lose on 6 out of 9 trades and still walk away with a significant net profit. All because those 3 winning trades were scaled up correctly. Their good ideas automatically became huge gains, while their bad ideas stayed small.
It completely corrects the paradox. It's no longer about having to predict the future 60% of the time. It's about positioning yourself so that your 40% of failures are meaningless and your 60% of wins are just maximized.
Okay, now that we've got the foundation of scaling, let's move to the master's blueprint. Let's unpack Jesse Livermore's detailed step-by-step approach. Because this isn't just about spreading risk, is it? This is strategic capital deployment. He viewed his capital not as a single shot, but as carefully guarded ammunition.
It's a truly scientific, almost militaristic view of speculation.
Yeah.
And we can break his one-quarter pyramiding rule into 4 very distinct steps, and each one is tied to a specific requirement from the market.
Let's start with step 1, the one-quarter probe.
This is the mandatory entry point. If Livermore planned on eventually buying, say, 20,000 shares, he would start with just 5,000. The whole objective is information, not profit. And crucially, that probe must show a profit almost immediately. It has to move in the right direction right away. If it just stalls or stagnates or declines, he saw that as an unequivocal signal that his timing was wrong.
And that's exactly where the amateur impulse kicks in. When that probe starts to drop, the amateur's first instinct is to average down. Buy more to lower the average price, hoping for a turnaround.
Exactly. The amateur thinks averaging down is a way to make the math work.
Yeah.
Livermore saw it as compounding a terrible mistake. His rule was absolute. If the probe doesn't confirm his judgment immediately, he closes the trade instantly. For a small, predetermined loss, the idea is faulty or the timing is wrong and he just moves on.
Okay, but if the probe is successful, if it gives him that green light and validates his analysis, then and only then does he move to step 2, the second one-quarter addition.
And this is the critical counterintuitive leap. This is the very essence of professional pyramiding. The second purchase must be made at a higher price than the first. So if you bought at $100, you are now adding more at $105.
Wait, hold on. That runs against everything conventional wisdom teaches us. If you thought a stock was a good deal at 100, why on earth would you buy more of it at 105? Isn't that just chasing the price?
The professional doesn't chase. They reinforce confirmed strength. That's the difference. Buying at 100 was based on your analysis. Buying at 105 is based on market confirmation. The market is literally telling Livermore, your analysis was right and the momentum is on your side. He's betting on proven success, not hoping for a reversal from a failure.
And it's at this second step that the entire risk profile of his position just changes completely.
Absolutely. The profit you've already made from that first successful probe, it acts as a huge financial and psychological cushion. It's basically the market financing your increased exposure. So Livermore would immediately adjust his stop loss upward, often moving it to just above his initial purchase price.
Walk us through that. Why does that simple adjustment make the entire trade virtually risk-free?
Because the profit on that first block of 5,000 shares is now big enough to completely cover the capital risk on the second 5,000 shares if the price reverses. So if the market suddenly turns against him, he can exit the entire 10,000 share position at break-even or maybe even a small net profit. So now he has 10,000 shares, a big commitment, but almost zero capital at risk. The amateur, meanwhile, still has 100% of their initial bet at risk from the very first tick.
That is the difference between speculating and just gambling. So after that confirmed success, we get to step 3, the third one-quarter addition. And this is the phase for calculated aggression.
It is the aggressive phase, but it's aggression that's backed by validation. By this point, the trend is becoming obvious, things are starting to accelerate, and the position is substantial. But critically, the speculator has this huge backlog of profit, which means he's now playing with the house's money. His confidence isn't based on his ego anymore, it's based on mathematical profit protection. The stop loss gets moved up again, locking in more gains.
And finally, step 4, the final one-quarter.
This last piece is added at new, higher prices, solidifying the full line. And this addition often happens during the climax or the euphoric phase of the move, which is the exact same moment the amateur, finally driven by FOMO, is probably making their first fatal all-in entry. The professional Livermore has now built his full position brick by brick on a foundation of validated success.
So once that full position is built, the job just transitions completely from this aggressive accumulation to pure management,
Mm-hmm.
which brings us to the final and maybe the hardest test of a speculator's character:
Mm-hmm.
patience.
It really is. It's the fortitude to just sit tight and let the great move run its full, logical course. And Livermore captured this with a profound simplicity that really should be on every trader's monitor. He said, "It never was my thinking that made the big money for me. It always was my sitting."
Wow. We spend so much energy on the entry, but the biggest money is made by just allowing the market to keep proving you right.
Precisely. The stop loss, which started as a capital preservation tool back in step one, is now a tool for profit protection. It gets methodically trailed up, securing gains, but you have to keep it at a respectful distance. Amateurs often trail it way too tightly and get whipsawed out of a fantastic trade. The professional understands the market needs room for its normal, nerve-wracking pullbacks before continuing the trend. You protect your profit, but you let the trend breathe.
So if we boil it all down, the core difference between the 90% who lose and the 10% who win, it comes down to this structured mechanical system. It forces you to be right before you're aggressive and profitable before you're heavily committed.
Pyramiding is an automatic system. It mathematically ensures that your largest bets are aligned with your most successful ideas. And at the same time, it ensures your inevitable failures, those little probes that don't work out, are always small, defined, and financially inconsequential. It solves that win rate paradox by maximizing the outcome of the right side of the equation.
So here's the thought to leave you with, connecting this ironclad logic back to life outside of the market. If the cold, hard logic of speculation demands that we only scale up our investment, that we only increase our commitment and our risk after the world confirms our initial judgment is correct, why do we, in life, so often feel compelled to go all in on a new venture, a dramatic change, or a major relationship before we have received any real confirmation that our initial conviction is sound? Maybe we all need to be a bit better at using a little Livermore logic in our biggest life decisions. Something to consider until our next